Good morning, everyone. A very warm welcome to CapitaLand Investment Sustainability Non-Deal Roadshow 2023. A very warm welcome to our HQ at Capital Tower, Singapore. And of course, we also have some overseas investors tuning in. Thank you for joining us. I'm Grace Chen, Head of IR for CLI. It's serious business today. We have three aims for today. Firstly, I want to make sure that you know that we care, and we care about that sustainability checklist you need to fill out for CLI before you go on your year-end holiday. So we're going to attempt to help you with that in the first hour. Our CSO, Vinamra, will take you through our sustainability strategy. It's a refreshed Sustainability Master Plan 2030. And secondly, ladies and gentlemen, I think you would agree that sustainability is a journey, and we can only progress with collaborations and partnerships. And of course, investing in our stock is a form of partnership, but there's more. Yeah, some of you have seen the innovations at our booths outside, but if you didn't get a chance to do that, do that during the break. These are innovations that are now piloting at our buildings as a result of CapitaLand Sustainability X Challenge, which we've held over 3 years. The last one was just held 2 weeks ago. And these innovations have actually sparked off a lot of good ideas and conversations, which I think is very valuable. And we hope that today, just by seeing them, experiencing them, it can fuel these conversations that can help progress our sustainability efforts together. And lastly, as a company, we believe in education and engagement, and therefore we thought it might make your time with us today much more worthwhile if you are hearing from not only us. And therefore, we have two very esteemed sustainability advocates, experts. We have Dr. Graham Riddle from Marsh Asia, and also Mr. David Fagati, Head of ESG Consulting and Sustainability Services, CBRE Singapore and Southeast Asia, to join us today with Vinamra. They will talk about the topic that was most voted by you all. And yes, if you recall, we asked you to vote across 3 topics, which we have right in front of you. Can I have a show of hands who voted for topic 1? Topic 2? Topic 3? And guess which is the most voted? Well, 50% of you actually voted for one of these, and I'm not telling you the answer. Well, we'll leave this to after the break when we have the panel session, so you stay with us. And just a quick note to people online that the chat box on Zoom is actually open. So please leave us a message, feedback, question. We'll try to get to them in the next 2 hours, but if we don't, we will reach out after the NDR. And without further ado, I'm going to invite our Chief Financial Officer, Paul Tham, for the opening address. Paul, please.
Opening address. I don't think I have very much to say. I just wanted to say welcome. Thank you all for joining us. Those of you online, thank you for taking the time. But, very often, every quarter, we go through results and briefings, and we end up talking through operations, all of our challenges in China, what's going on in our lodging. And very often, we end up glossing over sustainability at the end, because we always run out of time. So we felt that it was important for 2 reasons. One is because it's core to really what we do. I would actually say, we have a senior leadership council on our website, and I was thinking about it the other day, and I think between Vince, Pinga, and Ted, which is really our sustainability leadership, they have the most airtime in our leadership council compared to any other topic. In fact, I've gotten so used to seeing Ted there that if I don't see him, I think something's wrong. So it's something that we really spend a lot of time on internally. It impacts us from our investments decisions, to our daily operations, to our board governance discussions, to our nominations for new members. And so this was something important to us, and we felt that it was good to set aside time today to really just focus on this topic. So while I'm here, I'm really just here to support Vince and the team in this effort, and we're happy to take questions as we go. But we really wanted to spend today just sharing with you a little bit about our journey, but also to hear feedback from you guys on what are areas that you think we need to spend more time on, and where you think our focus should be as well. So welcome. I hope you all enjoy the session today. Thank you.
Thanks, Paul. Morning, everyone. I really need to calibrate next year. Do we need that overexposure with the Leadership Council, or it's a double-edged sword, or do we scale it down? Okay, before I begin, quick check. Any Aussies in the room or Kiwis in the room? You, yes. Beyond you. No, that's okay. No, I'm just mentioning that because the Cricket World Cup is going on, and yesterday India really beat Kiwis quite comfortably, and today the Aussies are in action. The semi-finals are on, so I wish you best of luck, mate. Come over, and then Sunday we'll beat you guys. Yeah, super. Thanks again very much. I think I have 25-30 minutes, and then we'll take Q&As as well. I think the best use of our time is not rehash things that you already know, because I'm hoping through all our consistent engagement on sustainability, there are a lot of things about master plan, etc., that you're well aware of. What we want to do in this session is give you an update of what has changed, give you an update of our progress in the year, what did we achieve, where we still have gaps, and conclude with what's coming up in 2024 in terms of our focus area. So these three things, and then of course take feedback from all of you as we progress. This slide is just a snapshot to lay out the macroeconomic context as it pertains to ESG. And I won't belabor any of these points more than what you see on the slide. But the context is just that things have become messy and challenging over the last year. Whether it's the geopolitics, or it's the interest rate environment, or it's the ESG backlash from different parts of the world, whichever way we look at it, all this is impacting the efforts that corporates are putting in it. It is unrealistic to expect corporate ESG efforts to be completely diverse from what's happening globally. And everything that we've been doing over the last 12 months has been keeping these trends in mind and accordingly pivoting and adjusting the way we approach our journey. So quick update on the numbers. Where do we stand? So the charts on the left are our scope 1 and 2 emissions over the last few years and the corresponding energy consumption. The trajectory is similar, so let's just focus on the carbon emissions. Two things to note here. The reason you see a spike between 2018 and 2019, which is a blue bar chart on the top left, is because of the merger of ASB and CapitaLand. And the reason why you see the line is the intensity on a per square meter basis. The reason you see the line dropping in that year is because CapitaLand's portfolio before the merger was more focused, as you know, on CBD office, on retail, on lodging, and the ASB portfolio was focused on logistics, industrials, business park, which have a much lower energy footprint than the former class of assets. So when the merger happened, while the overall emission obviously went up, but the intensity actually came down because of the addition of these lower energy intensity asset classes. Since then, COVID happened. So there were further drops because the footfalls were low. Now we are coming out of the COVID impact. I think we are quite happy to see that the emission profile has remained steady, even though our square feet footprint as well as our AUM has consistently grown over the last 3 to 4 years. And a lot of innovations that we have put in and invested, and you will see a glimpse of that later, in the last couple of years will start bearing fruits as these solutions get scaled up and a lot more AEIs happen in the portfolio. So I think we are quite satisfied with the fact that we've managed to keep the profile flat. And we are quite hopeful that as a lot of the investments that have happened in the last few years on green capex fructify, you will start seeing the results of those in terms of the energy outputs, which should get this trajectory going down. Notwithstanding the fact that our renewable efforts are significantly going to increase, as we'll show later as well, which will further bring this down. Now, the chart on the right is our Scope 3 footprint as we have been reporting till last year in our last global sustainability report. We have been reporting 5 categories of Scope 3 till now. And the major one has been the tenant's emission, which is technically what is called as downstream lease assets based on the greenhouse gas protocol. So we follow the GHG protocol. And these categories that you see on the right are those. So if you see this footprint, Scope 3 is around 60% of our whole portfolio. Now, the reason why that number is lower, because typically in the industry you will see scope 3 to be a much higher number, is because we hadn't calculated the other 10 categories. So an exercise that we are doing right now as we speak is a full-scale inventory of all the 15 categories. I think there'll be couple of categories more that will move this needle significantly. The rest all will not be that material, and therefore the scope 3 percentage will go up. So our plan is to conclude this exercise by this year end, and then hopefully publish the full category and the full inventory in our next sustainability report. And that will allow us to set a very clean baseline on what our scope 3 is, and then take it from there. This is the refresh of our 2030 sustainability master plan. I'll only highlight the things that have changed. The first change is the fact that our earlier master plan was aligned to a well below 2 degree scenarios. Now we have upgraded that this year to a 1.5 degree scenarios, which means now we are net zero aligned for scope 1 and scope 2, which is SBTi validated. So that means that our absolute carbon emission numbers and our intensity numbers all have, our targets all have increased for 2030. So our absolute 2030 target, absolute reduction is 46%. Intensity reduction needs to be at 72%. And we have kept the energy consumption targets the same, or intensity target the same, because we think we want to see what sort of efficiency improvements we are able to make because of our investments over the next couple of years, and then we will review them. So how are we then going to meet these extra carbon targets? That's going to come from renewables. So our earlier renewable target was 35. Now we have increased it to 45% globally. And of course, these are only headline macro numbers. They are all built bottom up. So different countries and different asset classes have their own targets. The second big change that we did was on the social pillar. We have now published a target specifically, as you can see, under the human capital development pillar in terms of diversity, in terms of staff engagement, as well as training and development. And we have further outlined much more clearly our focus on health and wellness, as well as the social impact that we create through our Hope Foundation, which is a social impact vehicle. And the third big change that we did was introducing the pillar of stewardship, which is linked to what we are doing on governance. It was always there in the way we structure our thinking as a foundation, but we thought it does deserve a complete clean focus in terms of governance, reporting, as well as risk management, as these topics become increasingly more critical as it pertains to ESG. A refresh very quickly on how some of the sustainability principles are integrated in our life cycle. I'll just highlight a couple of points here. The first one is at the investment stage. Our investments go through a detailed environmental health and safety impact assessment. And the couple of major themes there are any building that we acquire, or portfolio that we acquire. When it comes to the investment committee, there is a stock take of the current as-is energy for energy, water, waste. But let me just stick to energy to illustrate how we do the process. We do a energy footprint as-is currently, and we compare that with the 2030 targets, and we assess what the gaps are. And to the best possible extent, the effort is to underwrite the capex needed to meet these gaps. Now, of course, at the due diligence stage, you don't always have the perfect information. So it is an estimate at the best at those times, but that underwriting is done as best as possible. And then after the acquisition, in the first year of acquisition, we will typically do a detailed energy audit to further fine tune this number and convert it into a capex plan over the next few years. We also have an internal carbon price that we used to do this analysis in terms of the financial impact of the carbon emissions of that asset. After it is in the portfolio on the operation side, then it becomes part of our regular green capex management and portfolio management. And that is where all our operational efforts and initiatives then get implemented on that asset. And lastly, on redevelopments, this is a critical focus area for us. There will be quite a few of our assets across geographies that will go extensive AEIs or redevelopments. So we use our detailed sustainable building guidelines that was developed by our development arm, our private arm there. And those concepts are used, for example, adaptive reuse, etc., to make sure that all our redevelopments from the beginning are as sustainably designed as possible. And ultimately, from a governance point of view, all the teams, right from Chikun and all the way below, carry the KPIs for each of these portfolios as far as ESG is concerned, and make sure that they are on track for the 2030 targets. And these are part of the balanced scorecard framework for the entire group, right? Linking the compensation and our long-term incentives directly to that. So, of course, at the Chikun level, it will be at a portfolio level. So let's say our headline carbon emission numbers. And as we start going down to the countries and to the asset class and the portfolio managers, it becomes more and more granular in terms of the numbers. Refresh of the governance structure. The only thing I'll highlight here is the role of the strategy and the sustainability committee that sits in the board. That's chaired by our lead independent director, non-executive director, Anthony. And under this team, and Paul and I are partners in crime for this team when we link strategy and sustainability together every time we meet the board. There is a very deep engagement with the board, every board meeting and every ad hoc board meeting that we call on relevant sustainability topics. There's a continuous updating of the board on all the projects that the group is working on. And there's a lot of feedback mechanism from this committee and the board members from all the other action that they're seeing in other corporates and in other walks of life, and what are we learning for that. So there's a very healthy debate and engagement with the board at that level. So where do we stand in terms of 2030 target? This is sort of a report card. This is the first half numbers. I think next quarter we'll come out with the full year numbers. You will see these bar graphs track us against what I just showed you in terms of our target. Our sense is, you can see the energy and water targets, we seem to have already met them, but I just want to remind everyone that a lot of this is because of the low footfalls during COVID, which is now coming back. So I think this picture will change over the next few years. The one to focus on, I would say, is renewable energy, where we know we have more work to do. And now that we have actually escalated our target, and the reason you see the gap in the first line, the carbon intensity, where we are at 16% reduction from 2019. Our target is 72. We think we are doing okay on track, but a lot of this is because we've done well on energy. But because on renewable, there is still gaps. That's why the carbon number has room to improve. And the renewable number, just to keep in mind, for many of you, you may be checking year-on-year progress on each of these KPIs, right? There's a difference in how the energy reduction numbers will pan out year on year versus how the renewable numbers pan out. The energy reduction is usually more a straight line, or you can see a consistent 2, 3, 4, 5% decrease year on year. But renewable is a bit more binary. If I am able to lock in a green PPA for 100 megawatt consumption in one of my markets, and suddenly my renewable percentage may jump up. And then in some year, it may remain flat, right? So renewable is really dependent on the pace of rooftop solar deployment, and more importantly, offsite PPAs that I can secure, which will not be linear in trajectory naturally, right? So therefore, I think the renewable number, looking at it year on year, is probably not the best way. But of course, we still need to gauge overall, are we on the right track or not? But we do foresee, with a lot of efforts that's going on, and I'll show that in one of the next slides, we do expect this number to spike up quite considerably in the next few years. Okay, this was a recap of what we had set for ourselves early this year, in the beginning of this year. And I think, if I'm not wrong, I showed this as well in the last investor roadshow that we had last year. I wanted to rehash that because it's only fair for us to give you an update of what and how we are doing in all the focus areas we had set out for ourselves in 2023, right? And these were the 5 focus areas. And over the next few slides, I'll give you a sense on where we are on each of these 5 focus areas. We laid down this strategy to make sure that we are clearly aligning our efforts and initiatives on the ground to what we need to focus on to meet those targets. And we said there are 4 things that we want to continue to focus over the next few years. The first one is deep execution on our decarbonization pathways, Scope 1 and 2 right now, and Scope 3 as we are continuing to progress. And this is probably the most central and critical where a lot of organization bandwidth goes. The second is the community impact that we are creating through our Hope Foundation vehicle, which will multiply an effort, and I'll show later in some of the plans there. But that is very critical, especially to the S part of our ESG efforts. The third is our efforts to see, can we use ESG themes to create new products and new revenue engines and growth engines for the business, whether it is in the private equity space or otherwise. And this is sort of a forward-looking future thinking to see what areas can generate new growth engines for us beyond the asset classes that we are already invested in. So there's a lot of homework that is going on behind the scenes to assess new product ideas based on ESG. And the last vertical is more internal, which is the focus on capability building and making sure that we have the right culture, right systems, right processes, right data analytics in place for us to be able to do a smart and intelligent portfolio management as we move to our targets. So everything that we will be doing, and that's a challenge I throw to my team all the time, that every minute of your day that you're working, you need to be able to bucket where it is in these 4 pillars. If you're doing anything that is not in these 4 pillars, you're wasting your time. And this will always guide us to make sure that the organization is focused on what it needs to deliver. Few examples of how we are bringing these initiatives to life, right? These are some of the examples of what we are doing on the energy efficiency pathway, which is the most critical one along with renewables in our carbon mitigation hierarchy. So for example, all these assets that you're seeing are where we are having extensive green capex upgrades. It could be major AEIs, the likes that we did for example, 21CQ or now Clarkey, or it could be minor green capex refresh. But either ways, there is a strong focus every time that there's a capex refresh happening in our assets. There's a huge sustainability focus in that refresh. The second is smart building analytics. So a big part of energy efficiency is not just the hardware upgrades that we are doing, but also on the SaaS solutions that we're executing and implementing to make sure our buildings are operated as automatically and as smartly as possible. So there are 4 to 5 major pilots right now going on with different technology partners on different assets, where we will be comparing the results of how much energy savings and cost savings we are getting from these initiatives, and therefore how to scale up. Some of them have already been executed significantly. And just as a reminder, even without these pilots, we have more than 60 buildings in the portfolio that today run on our intelligent building platform, which is a Johnson Controls platform, that have already automated the functioning of all these buildings, and that is giving us double-digit savings already over the last 2 to 3 years. But at the same time, given the extent of our portfolio, we continue to work on other pilots. And the last one is new energy model. So this is more around how can we maximize district cooling systems in some of our buildings, and more recently, how can we leverage on cooling as a service to further create opportunities for our buildings where we may not have a DCS opportunity, but we do have an opportunity to work with a technology partner where we can actually offload our entire cooling system and set the right KPIs and SLAs, which meets both our cost as well as our sustainability targets. So this is a major exercise that we are already running right now. We have tenders live that are in the market for a good chunk of our assets, starting with Singapore. And from the initial feedback, we do see significant potential for cost savings as well as energy savings if we turn to this model. To what extent we'll scale it up will depend on how the pilots start off, but we will have more progress on this execution next year. On renewable, we've got significant progress in markets where renewables offer us good opportunity. So for example, in India, around 40% of our entire energy needs is today sourced from renewable energy, mostly on the back of 2 strong PPAs that we have in Bangalore, which runs almost 90% of our energy needs in that park. We also have 3.8 megawatt of rooftop solar. Almost every building now in India has a rooftop solar, and that's the default as we continue to expand. And at the same time, in markets, you don't see it here, but in markets like Australia, we recently stitched together a different kind of partnership model where now we have 63%, if I'm not wrong, 63% as our renewable consumption in that market. But there we don't have long-term PPAs right now. It's a short-term contract, and we are looking to convert that into long-term PPAs. Europe has also made significant progress. 4 of our data centers there run on renewables, and we also have Ascot properties there running completely on renewables. The markets where we have more homework and effort to put in is obviously Singapore and China, and these two are our biggest market, and that is where we have a task cut out to work. And there's deep work going on in both these markets on not only securing renewable PPAs, but also in looking at alternate options to expand green sourcing. And as we have more updates, we'll keep you informed. But all the conversations that you see in the newspapers here in Singapore on the different renewable options, so whether it's a renewable energy import or whether it is other forms of energy, we are plugged into all those discussions. So as those projects at a national level fructify, we want to make sure that we are at the right place to benefit from it in a model that is commercially the most viable. CSXC, our Innovation Challenge, actually has had an interesting success, I must say. I think this was our third edition. This year we got more than 680 entries from around 80 countries. I think the focus this year was not just on enhancing the number of entries we get from climate tech innovations, but it was also to expand our partnerships. We do believe this is a platform now that has a very strong equity in the market to expand partnerships. So we did 2 types of partnerships. One was with BCA and Enterprise Singapore. So this is where we show public-private partnerships. BCA, because not only BCA's role as a regulator in guiding us on the right areas to focus on is critical. So the way BCA was mentoring our startups and the way we partnered them in innovating their own new sustainable building gives us a lot of insights on the areas for us to focus so that we get the right support from the regulators. And Enterprise Singapore, because Enterprise Singapore not only funded one of our awards this year, but they'll also be a key partner when it comes to supply chain learning and development going forward, because that is clearly one of their mandates. And they're very keen to work with us as we go forward. The second kind of partnerships we did was with tenants. And this was, again, with focus on Scope 3. So we said that the solutions that are going to pass through this funnel, we will implement them not only in the landlord areas of a building, but also in tenant premises. So we selected 3 tenants, DBS, DFI Group, as well as KPMG, in different assets. And the technologies that have been shortlisted are going to be piloted in their premises, which will help reduce their energy consumption, their Scope 2, and thereby our Scope 3. The third main change we did with CSXC this year was expanding the focus areas. So beyond our regular energy, water, etc., we have now expanded it to embodied carbon as well as safety. And it is interesting that out of the 4 winners or the 4 top solutions that came in, 2 actually were from these 2 new areas, one safety and one embodied carbon. So we are very glad that we expanded this because it has a much tighter integration with our ESG efforts now. So this is just a snapshot of our top 10 from this year, which will get implemented. I won't go through each of these solutions. We will be happy. I think the deck is already shared, so we'll be happy to take any questions from you on these. But as you can see, these are all targeting different challenge statements of energy, water, waste, wellness, and safety and embodied carbon. And we've got a good mix. So all of these are now in the process of getting matched with which asset they're going to get piloted. We are working to stitch up the contracts, etc. And we do target that by Q1 next year, the actual implementations on the ground should be starting for each of these solutions. And some of them actually are very cool technologies. We had these guys, what you see as Megorium, the number 4 on that list. What they do is they take both contaminated and uncontaminated plastic waste or any sort of waste, and they convert it into asphalt that can be used to pave roads. And right now, they have been doing a lot of private roads in Singapore, including the DBS campus and a few others. They're working with LTA for public roads, but even otherwise, in a lot of our business parks, we have a lot of private roads. This can go in there, right? We have Another one, which is the corrugated solar roof. And this is a different kind of solar panels. They are much lightweight. They're more flexible. They can actually stick together like a sticker to corrugated roofs, because a lot of warehouses, for example, has corrugated roofs and they don't have the right tensile strength to take the heavy panels. So these things can put in there. They can also be used as BIPV on non-roof surfaces. The Healthway family that you see there, that's a low pressure drop filtration. So it not only improves your air quality, but it's actually reducing the load on AHUs, right? So I think there are significant technologies that are coming through these challenges. This is a report card of what we have been doing over the last 2 sets of technologies. So we want to make sure that this whole platform for us is less about sort of having a one big demo day event, but it's more about really implementing the tech, right? So that's why tracking these techs is super critical for us, and we have a very strict protocol through which these go through. So as you can see there, we've got 3 that have been completed that are going to get scaled up right now as we speak. There are 2 where we already got interim results with significant energy savings, and all the ones that you see on the right at different stages in 2024, they're all going to get completed and they will get scaled up. So our focus continues to remain on making sure that they pass the pilot protocol, we can stand by the savings, and then they get executed and rolled out in front of the assets. So again, these details will be with you in the slides. Very happy to take specific questions on any of these pilot progresses. I'll wrap it up quickly. Scope 3 will be a key focus areas for us to go forward, right? And there are 4 things in Scope 3 that we'll be focusing on next year. Enhancing the data coverage. So as I mentioned, we are doing a full inventory of the 15 categories. We'll be working through our green leases significantly with the tenants to focus on tenant energy consumption. We will be working, now that we have quantified the supply chain, we already have a list of the, at least at the sample of our major suppliers, what their ESG maturity level is. And we're going to run a lot of programs, not only in terms of how can we support their own adoption, but also in terms of strengthening their L&D to work with the supply chain. And finally, continue to work with the CapitaLand development on the embodied carbon effort. So there are many efforts going on in our sustainable building guidelines process on how to use low carbon materials, how to use adaptive reuse. It is important because even under CLI, we do a lot of extensive AES and redevelopments, and that is where this focus will be critical for us. One of the last slides, I just wanted to showcase that behind, you will not see all of this in our press releases or in our other road shows. But this is what goes on behind the scenes in terms of data analytics, right? And we're heavily focused on portfolio management and use of data for that, right? So these are just some of the examples. I talked about our EHSI at the investment stage. I was just sharing that we are right now, the second graph that you see, we are right now doing completing a climate scenario and value at risk analysis. This is not only required by TCFD, but we are actually comparing that to our own CAPEX assessment, because we do have a sense of what CAPEX we need to meet our 2030 targets. And we are linking the two to see, is my short-term CAPEX allocation in the right areas of our portfolio where the long-term risks are based on the climate scenario analysis. And we are trying to see if there's a mismatch, how do we address that mismatch? Again, very heavy data driven, right? We have portfolio dashboards where we continue to use, so these are all live, right graphs. We have just normalized them. There are no names there. We continue to track every single building in the whole portfolio on their month-on-month movement, year-on-year movement. If there are anomalies, it allows us to benchmark as well. For example, these are all the malls, I think, in Singapore for us, right? And how do they stack up, right? And then, of course, we are continuing to monitor ourselves on the CREM curve, right? The CREM curve has gained a lot of traction in the market recently, and we continue to track our assets on the CREM curve. The CREM curve has a lot of challenges for Asia, as many of you may know right now. It is a very Europe-centric model, but at the same time, it is important for us to be aware where do our assets stand on the curve, and that's an ongoing exercise that we keep doing as well. Our Hope Foundation continues to expand. We have, not many of you may know this, but we have actually been contributing more than $60 million already through our philanthropic efforts across all our geographies. These are some of our flagship programs, one of them being schools that we build for the underprivileged across our geographies. And under CHF, we will continue to strengthen all these efforts as well. Safety is extremely critical for us. We have, thanks to the help of Seat, our Chief Safety Officer, who's here, we have actually outlined 4 very clear areas of where we want to focus on in terms of safety, and they pertain to capabilities, mindset and culture, use of technology, and use of partnerships. And we continue to deep dive on these. Just a fun trivia, the photo that you see on the left with people on the helmet and jacket, that is Chikun. The one second from left is Chikun on the roof of RCS, was it? Raffle City? Yeah, that's him on the... So we get every member of our leadership team to do site walks regularly at different assets. They go back of the house, they go to all the non-sexy areas, and from a safety point of view, and it also helps them to stay closely engaged with our asset teams on the ground. And we have, over the course of the year, conducted many, many events internally to strengthen our culture and capability buildings through the help of our HR teams in curating the right programs. So significant amount of roadshows, brown bags, topic-specific sessions to make sure that the entire organization is on the same page on our sustainability journey. I'll leave that slide for later for the Q&A because I think it's more relevant there. So that wraps up a summary of sort of a progress report of where we are and where we want to go, what we are doing well, where the gaps are. I hope this gave you a bit more detailed flavor. We'll be very happy to take questions. Grace?
Thank you, Vince. At this moment, I also invite Paul to take the hot seat beside Vinamra. And I want to direct your attention to the screen now. Can we have the slide up? Yes, we've gathered questions from all of you so that we could guide our focus for the next 30 minutes. And as you can see, these are only part of the questions that we've received. We've identified 4 themes, which is what we will focus on. So green returns, governance and reporting, innovation and partnership, and stakeholder engagement. So to kick off the Q&A, I want to get Vince perhaps to provide his thoughts on the themes, and then we'll open the floor to the audience for questions.
Thanks, Grace. So this was quite interesting, and I was quite pleased to actually see so many questions coming in on green returns, right? So we'll not go through question by question. You can see the questions on the screen. I think we'll just focus on the themes here. So let me try to give our take on the elephant in the room, which is on green returns. And later in the panel, we'll have our 2 expert gentlemen share more thoughts around it. So the theme of the question is there a trade-off between achieving our sustainability goals and making profits for all of you, right? I think how I try to, and I've shared it with the Leadership Council as well, how we see it is as a spectrum, right? On one end of the spectrum, you do everything because you want to make sure that you are sustainable and green, right? And on the other end of the spectrum, your only focus is dividends and profitability, right? And questions like these are provocative to push you to either of the extremes, because that's what makes nice headlines. The reality on the ground from our experience is that the reality is much more boring, and the reality is that you tread across this spectrum every day of our work. Sometimes you're leaning more on one side, sometimes you're leaning more on the other side. So it is a portfolio management exercise for us. I try to emphasize sustainability journey for us is no different from a portfolio management exercise that the portfolio managers of our REITs are doing today. It is about, we have limited capex, we have limited funds, we have limited manpower, limited resources. How do I best allocate these limited resources to my entire global portfolio in the most wise and smart manner, which can get me most bang for my buck and at the same time help me meet my sustainable goals? And we do believe that this is not a contradictory trade-off. It is more about smart management of where you allocate your money, right? And how does that money give you returns in whatever ways we can? We try to lay this out a bit more scientifically as much as we can, because it can be a very fluffy topic, right? People can point you to tons of surveys where everybody says, oh yeah, green makes money. May not always be entirely tangible, right? So we try to put it in 3 buckets, right? Let's look at OPEX. More investment in energy efficient equipment, more utility savings. I think this is the most straightforward argument that we can give to where the returns are coming from, right? So I won't belabor that point. The second is renewables. There are many geographies where renewables are getting parity with brown grid power. Our India properties are a perfect example. The PPAs that we have are allowing us to secure green power for a long period of time at at least 30 to 40% discount to brown grid power. And that's because state governments have pushed this for renewable push. So we're already saving money there, right? Same with a lot of our rooftop solutions as well. The other way to look at it is through carbon tax and offsets, right? The browner assets will have a more carbon tax outlay, whether we like it or not. And this is not a guess or a projection. This is real, right? Today it's $5. It's going to go to 25, and it's going to go to 50 to 80, which we already know it's going to happen in Singapore. So the browner. So would I put my money in a way where I can still get some returns from the asset enhancement, or would I just give it away in taxes, right? And the same logic for offsets. That's not real today, but eventually in our net zero journey, you will have to fork that money out to get the buildings for your gap at the end. So whichever way you look at it, we are going to have a cash outflow, right? The second is revenue and valuations. And this is where it gets a bit more subjective, but I'm encouraged to see there's a lot more quantitative research happening there, right? So on the leasing side, right? On the leasing side, we already have seen many instances where customers, even if they tell you that I'm not going to pay you, 5 cents extra on a square feet, but there are many, many instances clearly where they may not prefer your building if it's not green enough as the building next door. And if that happens, then you're just going to take longer to lease the building, which is again going to impact your IRR, right? So there is that indirect effect in terms of leasing timelines, which we are seeing come into play. Not everywhere, but we are seeing it selectively starting to happen, especially with the MNC clients who have their own net zero goals, right? The green premium and asset valuation is referring to a lot of research that is being done to actually show all things alike: age, location, technical specs, etc. Greener buildings may command a small financial premium or a brown discount, whichever way you look at it, right? Now, this is subjective. I don't think I can point you real hard evidence that, oh, this happened in this building, this happened in this building. I can't, and I don't want to, portray that I can. But what I can say is that there's a lot of research that is happening in this space, and I'll be happy, David, for you to share some of it, that what you see from a neutral third-party perspective. But how we see it is that if we don't do the right investments at the right level, we may still end up with a stranded asset issue. And the stranded asset issue is not that I can't do anything with the asset. Of course, I will be able to still sell the asset, but I may just have to bear a brown discount because it's not green enough. Or it may take me longer to find the right buyer, which again is a drag on my returns, right? Just the way when I'm buying an asset today, and when it goes through my investment committee and I underwrite the green capex that I just mentioned, the same may happen when we sell the building as well, which may again get reflected in the price, right? Now, how much of that price discount is attributed solely to sustainability versus to other factors? We don't know. We can't isolate that today. So I may not be able to attribute it quantitatively, but I can definitely know that there's a contribution of it, right? And that's where that journey is, right? And the third pillar of where green investment may make sense financially is, of course, in financing, right? Interest rate savings from SLLs are a very clear-cut example, right? Project financing for green AEIs that we do, expanding the pool of investors, credit ratings. So I think all of these we feel are the ways in which green returns make sense. What we are trying to do, there were some questions on our return on sustainability progress, which I think a year back or so we had shared, we are working on. So what we're trying to do now is take some of these points, and there are some that are not there, for example, insurance premiums, right? And we'll have Graham talk a bit more about that later in the panel. We haven't yet put that on the slide, but there is an impact of that happening as well now. So what we're trying to do is trying to take a portfolio of sample assets, try to quantify some of these as much as we can, and try to see what happens to the return. So we are doing these simulations. We'll keep you updated how that looks like. But at least as an organization, this gives us a clearer picture on where there is money to be made. And not everywhere we may meet our hurdles. We understand that. And this is why it's all about smart asset allocation from a risk perspective. So that's how sort of I see it, and our team from a sustainability perspective. But Paul, I want to get your thoughts here. You are the man holding the money, holding the purses. What you think matters more than what I think on this point. Any thoughts you want to share? Yeah.
Shucks, I was hoping he would answer that first question that was on the board on what's the ROI on ESG investments. But I think, just as Vince articulated, it's actually very hard to pin down specific factors. But we do know that there is an overall uplift, and we can see that whether it's through cost savings on the buildings or through potential divestment prices on assets we're selling. But I would just say, I think what Vince mentioned on looking at it as a portfolio is actually one of the critical things we do. We'll always have some spend on sustainability or green, which improves and makes us more efficient and saves us money, and we will have some that does not. And some we do this because it's what we believe in, or we believe that there should be a certain level of standard across all of our buildings, and we won't always make money on that. But when we weigh it on an overall portfolio, which is how we approach it, I think just as Vince said, it's just making sure we spend our money in the best place possible. And I'm going to remind him of this every time one of these comes up now.
I told you, anything that we do is a double-edged sword, right? Look, and there are a couple of good examples on this, right? I was just looking at some stats early in the morning. So the 21 collar key AEI that we did, right, that has given us a 712 megawatt hour per year savings. And it has given us $107,000 of cost avoidance if we hadn't done that AEI, right? If I look at what we're doing in Clarke Quay, the impact is yet to be out because the renovation is almost completed. But if you look at the inputs, the kind of solutions that we put in, that can give me 30% heat savings, 50% cooling load savings, embodied carbon savings, and we have all that quantified, right? We look at India, we upgraded our buildings to platinum levels, and all that has given us, again, more than 1 million kilowatt hour savings per year, $145,000 of cost avoidance. We were at a stage where we had to upgrade the chillers of few of our individual buildings because they were almost end of life, all of them. And we have 12 buildings in that park in Bangalore now. And what our property management teams did is that say, look, in the next 2 to 3 years, I have to replace these 5 chillers at different points in time. Let me try to see if I can create a brownfield DCS mechanism so that I connect them and therefore instead of 5, maybe I only need to buy 2 chillers. And we managed to do it. It was sort of a back of the house innovation. And what they did was through the rooftops, because all those buildings were nearby, through the rooftops, we actually connected new pipes, etc. And we connected 5 buildings, if I'm not wrong, and created a workaround where it became a DCS system on an operating asset, which has been operating for like 15 years, instead of buying 5 new chillers. So now the team only had to buy 2 new chillers. And we saved, I've got the numbers, the amount of savings that we did there as well, right? So it's these kind of innovations on the ground that gets us these savings, incremental savings as we go along, right? So maybe I'll stop on this point to see if there are any questions from the floor on this topic of green returns before we move on, or anything online that you see.
Before that, just a quick note that the session is being recorded, but your faces won't be shown. So I just want you to feel free to ask questions. And of course, our viewers online, you can also type in your questions for us. But actually, I think that's all we need, right? He's answered most of the questions.
Okay. But please let us know if there's anything.
Who wants to get the ball rolling? Yeah, Joy.
Joy from HSBC. 2 questions from me. One is on the targets. You mentioned about renewable. How, what percentage of your target is actually dependent on external factors, meaning the availability of renewable energy in that particular market, and where you see the most challenges, across your geography? Second question, I guess more on capital allocation. So certain asset classes has a much heavier carbon footprint, like data centers. Is there a green sort of scoring you're putting on when you allocate your capital? And how should we think about, this going forward? Thank you.
Sure, I'll take a stab at it. Paul, please feel free to jump in, especially on the second one as well. So the first question, absolutely yes. The key thing with renewable procurement is that for us to be able to meet that 45% target, we have to go and get off-site power purchase agreements. We can't do it just with rooftop solar. Right? And that is heavily dependent on 2 things, on the regulations and the openness of the market and the price points. Because there may be cases where regulatory-wise, they are absolutely open markets. Any private sector can access, but you have to pay a 15% premium. So then it again becomes a question of, do we want to pay that and increase our cost bill in order to get that, right? So I think the geographies where there is a challenge right now is Singapore and China. for Singapore because of natural capacity unavailability constraints, and for China more because the market is not yet that open for private sector, and wherever it is open, there is a significant premium. So all the big tech firms that are the Amazons of the world that are getting the green power there, they are paying that 15-20% premium, right? And that is what we are working to calibrate. We do believe that the market will significantly open up thanks to the policy push by the Chinese government on renewables, which is very clear for us to see. So we do believe that we will get good parity there, but we have to continue working. And there are some pilots that we may be trying to stitch together next year. In terms of, let's say, hypothetically, that these markets don't open up or the price premium remains, then what are we going to do? We'll have three options. One, pay the price premium and compare it against the carbon tax I'll have to pay if I don't pay the price premium, and do the math accordingly. Two, buy renewable energy certificates. And we already have completed an internal exercise where we have quantified, we have forecasted how much renewable we may be able to get by 2030 based on current progress. We have seen the gap from our target, and we have said, okay, for this gap, I'll need to buy RECs, and what will that cost me? The good thing, at least with RECs, is that you can go and buy them. You can buy it in China. Singapore is slightly more challenging, but we are not RE100 compliant. We are SBTi compliant, and that may allow us to buy RECs from within ASEAN. It's still not confirmed. There's a lot of moving pieces there, so I don't want to commit anything, but there could be a possibility where we could buy RECs from ASEAN, which may help us meet the gaps. And then as the last mile, which we don't want to do by 2030, but much more closer to our net zero goals, will be offsets to meet that gap, right? So that's how we're thinking about it. And of course, I'm not even going into what may happen to alternate technologies in getting cost-efficient hydrogen, ammonia, etc. And there's significant investment happening in Singapore. So that we'll have to wait and watch. We are not an investor in these areas, so I don't want to comment on that. But we do believe that we have those options available as well. So that's how we are thinking of the strategy right now. But I think at this stage, all our focus is on stitching these PPAs together. On your second question of capital allocations, clearly. So one, our targets for each asset class themselves are very different. So data center has a different target than a retail mall, etc. For heavy ones like data centers, our going-in hypothesis is always to stitch together a renewable energy plant from the beginning. So whenever a DC investments come to the investment committee, we need to see if it has a corresponding renewable energy plan. It may not be from day one, that's fine, but there needs to be a path to get there. So we're trying to minimize the issue right from the beginning. But beyond that, we have a three-pronged strategy for data center, which is green design, green operations, and green energy. So the green design and the green operations is about, we have a very detailed green design guidelines for any new build data center that we have. And then, of course, in green ops is about energy efficiency. So it's a combination of all these three that we hope will help us. Paul, on the capital allocation, any point there?
Yeah, I think Vince articulated quite well how we look at the investments and making sure that we have a green plan related to potentially some of the assets. So it can work for certain assets. I mean, data centers will always be a little bit of a drag and challenging for us overall. But we consider data centers to be part of our portfolio. When we look at our overall capital allocation, we're not going to be a very big data center player. I don't think that's necessarily, as you can see, we've still got a lot of retail, office, lodging. So when we look at the overall portfolio, we know this is not necessarily a big swing factor, but we do make sure that we have an implementation plan in place. But there are other sectors actually which impact us, such as US multifamily, where it impacts our other green targets. And we've had quite long discussions and debates about, for some of these sectors, whether that ties to where we want to allocate our capital, because we know it affects us on the overall as well. So we do consider it. Obviously, we don't reveal our capital allocation strategy by asset class or country. Nice try though, Joy. But we do keep it in consideration. So actually, for us, as most of you know, we are rebalancing a little bit, as we announced during the results last week. We're trying to put more focus on India, Southeast Asia. The benefit of more focus on India for us is the abundance of renewable energy. And that hopefully will help us a little bit more in terms of meeting our targets. So we do consider it in our shifts and some of our allocations. But I would say we are fortunate in the sense that the team has done a good job, and it's not a major impact on us hitting our targets.
Thanks, Jess.
Thank you.
We'll take the question. Oh, sorry. Yeah, please.
Yeah. Hi, Vijay from RHP. I have a question regarding How robust is your data collection and data validation, especially across, you have assets across different asset classes, different markets, etc., which may have different data sets, which may not sync with all of them. Maybe can you explain a bit in terms of your process and what challenges you face and how do you solve them?
Sure. Why don't I get, because I think you will be tired hearing from both of us, why don't I get Pinger to address it very succinctly? She's our reporting, governance, data lead for what we do. Pinger, do you want to share very briefly how we approach this?
Hi, my name is Pinger. Just to give some background and to point on your question, this year when we published our Global Sustainability Report, it's our 14th report. So since 2009, we have been reporting. By 2010, the report is externally audited. And by 2013, the level of audit has gone up to an A1000 standard. The reason is when we started on this journey, two things are very important. The data quality, completeness, must be important for board and leadership to make decisions. So how do I get data? We go through a platform. We do checks. Every quarter it's updated. There is an internal audit process. And we go through external audit. And in the early years, you will see that, yes, we had challenges, different markets, different countries. So we had slight restating in data. By the end of the day, what's very clear, when we start, it must be to international standard. It must be consistent from China, from India, from Singapore, any part of the world. It must be able to be consolidated. So I hope that clarifies.
Yeah, thanks, Pinger. A couple of things to add there. Yes, we do have issues. We have, country X delayed by 2 months, 3 months, and I see the dashboard. I say, hey, how come there's a big gap here, right? So on and so forth, because there is still a lot of manual intervention, right? So we are doing two things. Next year, we are going for a major overhaul upgrade of our environment tracking system, which is our cloud-based platform that we are using currently. But because we've been doing it for so long, the technology has evolved significantly in the last 2 to 3 years, right? Now there's a lot of automation. Systems can directly connect to your BMS. You don't need, you putting in the energy data. They can integrate to the ERP to put in supply chain procurement data directly for your scope 3. So we are going to do a major review of it next year and see how do we go to that next level of automation. But currently it is robust enough. It is painful because a lot of it is still manual, but we're taking that next step, yeah.
Thank you. Any other questions from the floor? Okay. Charles?
Thank you. Charles Yance, Macquarie. So yeah, thanks. Based on how much progress you've made on energy efficiency, clearly you already considered a lot of the low-hanging fruit for cooling, but I guess there's still a lot to come based on all of the different initiatives. Could you talk through some of those? Where can we actually see improvements in cooling specifically?
Yeah. I think one of the major ones, Charles, will be cooling as a service. Cooling as a service because we believe that if we have the right technology experts actually take care of that part of our asset operations, and we have the right SLAs set to meet our energy targets, it can give us a lot of economies of scale, a lot of pooling in, and then because of these, the way the contracts will be structured, significant energy savings. And I'm saying that is major because that's a major shift in a business model. Right. So far, we own all our capex, all our HVAC. We have people on the ground to do that. This will be a major shift. Of course, it will happen in small phases, but it's a different methodology the way we are looking at it, and I think that will move the needle significantly. The other thing on energy, I think that will move the needle significantly is our SaaS solutions expansion. Right now, I mentioned, okay, we have 60 buildings, and we're getting these savings, but we also have all these pilots ongoing, which when they complete by next year, we will roll them out extensively across many of our buildings. And the reason I say that this can move the needle significantly, because if we get that right, if we get the right assets that are connected with all the sensors and everything in the building is automated, your energy savings can be as high as 20% plus, right? Even if you take a Green Mark Platinum building today, which meets the green certification criteria very well. And David, you are an expert, and maybe you should take this in the panel later. you will still be surprised of how much more energy you can actually squeeze out by smart automation of the building. So I wouldn't discount that part of energy efficiency. And the third pivot, I think, will be when all these 30 technologies or 20 in progress that you saw from our Innovation Challenge and 10 from this year, when they all graduate from their pilots by early next year, and there'll be bunching of them, that scale up will give us these new avenues to target areas which so far we had not targeted, because they are new innovations. They're not BAU solutions. The one that I was talking to you about earlier were more still BAU, even though not everybody's doing it. But these ones are genuinely the next generation. So I think we have these 2-3 different ways of addressing, both through BAU deepening and through expanding to new innovations, where we think we can significantly get more energy efficiencies. And hopefully that will also help us in tackling areas where renewable may still take some time in some of the assets.
We've got a question from Mervyn, who's watching us online. Singapore is increasing carbon tax over the coming few years. Can you please talk about the initiatives CLI is undertaking to reduce the impact on the bottom line and capex involved to minimize the impact?
I think we discussed a lot of initiatives that we're doing to reduce the carbon footprint. All of that will imply that we have to pay less carbon tax. So I won't detail them again. All I say in terms of capex involved to minimize the impact. So as a process, after we already identified the green capex we need till 2030, now as a process, every time Paul oversees our budgeting process, our budgeting cycle, every business unit has to delineate the green capex of all the $100 of capex they want to put in. They have to say, okay, how much of this is actually green? And we compare that with our plans, and we see where the gaps are, why the gaps are, how are we going to make it up, so on and so forth. So there is a robust process now where that capex is getting translated into the budget process. So for us, it's really all about that execution as we go forward. Anything you want to add, Paul? Yeah.
No, I would just say it's a little bit hard for us to necessarily separate that out as well. So, for instance, if part of the capex plan for our buildings is to put in a more efficient chiller or cooler system, it's usually also because it's at that point in the life cycle, and so we tag it in. So I wouldn't say we can categorize specifically that these are intended for reducing the carbon tax, but it's really just making the building more efficient. So while we do tag what is green capex, it's actually quite hard for us to differentiate.
Yeah. And actually, that's a good point, Paul. That's also the reason I remember some of you had asked me earlier, what is that green capex number that you put in? And it's not that we forgot about the question. We actually did a lot of thinking, and we felt that I don't think it's fair for us to sort of put that number out, because it'll be easily be misinterpreted, because a lot of it will be muddled with examples that Paul mentioned. It's still green, but I would have done it even if I didn't have the 2030 target. So we don't want it to be misleading, and we're very mindful of any greenwashing concerns. So we would rather, behind the scenes, keep doing the hard work, right work, and let you guys see the results on its own. Yeah.
I think we still have time. Wait, Hong?
Hi, Hong Wei from OCBC. So just a couple of questions. The first is that you set quite a number of targets, like let's say on energy, on emissions and water and so on. So is this applicable for the group, including CapitaLand development? And how do we think about the REITs? Do they have the specific targets to meet also? So that's my first question. And my second question is on, let's say, on your cost of equity and cost of debt. Has that changed as a result of your actions in all these areas?
You want to take the second question first? Then I'll take the first one.
Yeah, okay, I'll do the second.
I get him to take the tougher ones. That was our deal.
Generally, so in terms of cost of equity, I would say no. If you've seen our share price over the last year, we have swung up and down quite dramatically. And obviously, there are multiple things that factor into our cost of equity for us. So while I do think our sustainability journey has been additive to us as a stock, I don't think it has had very much impact in terms of cost of equity. In relation to cost of debt, we used to see better benefits. So for the bankers who are in the room, we used to see better savings when we did a sustainability-linked loan or a green bond, I think. But particularly for real estate in Singapore, I think the market has become a little bit more saturated, where we used to see maybe 5 basis point savings. These days, I would be surprised if we really saw even 2 basis point savings. The truth is, I would say at this juncture, it feels like a lot of lenders or investors, bond investors, have kind of gotten their fill to a certain degree. And if we were to go out, yes, we can tag a green stamp on it if we wanted to. But if we didn't tag a green stamp, we would end up at the exact same lending rate. So we still will, in many cases, go out for a sustainability-linked loan or a green bond, with the intent being that this also keeps us honest in terms of our KPIs and ensuring that from a sustainability point of view, that we are also looking after our green portfolio and green loans. But I would say the days where we used to see savings on that cost of debt makes no difference almost to us these days. I'm more than happy for any of the bankers in the room. If you want to come to me after this and prove me wrong on that statement, please do.
I think he made sure that's why he says that, so that we see can we get something better. To the first part of the question, the target setting was done bottom up at an asset level and then aggregated at the top, which means that, let's say this building has its target. And so then when you combine all such buildings, that becomes CICT's Singapore commercial target, and so on and so forth. So then you have different cuts and slices and dices of it. So therefore, the headline number that you see underneath it, every REIT, every asset class, and every country operations, they all have their corresponding drill down targets that they have to achieve. And if they do all of that, then we meet our top level target. Now, on the development side, now, of course, for REITs in particular, if they want to go over and beyond, we're more than happy. So, there is a lot of independence there for each REIT to also pivot. So, for example, our India target is 45%, right? Now, our India Trust is almost 3/4 of our portfolio there. So, with the huge focus we have on renewables in India, we do hope that we should beat that. We're already at around 40%. So Sanjeev has a full license to maximize that, and I'm very confident he will. So then each REIT, of course, then takes it further. But the baseline is at least we make sure we're at the group level there. For CapitaLand Development, so after the split, the CapitaLand Development team is working on deep diving on their own targets, which are more development focused. Things like embodied carbon or things like energy and water on the construction side. And then there'll be the operational target for the buildings that they own. They are almost as similar as the CLI operational targets. So there's not much difference, but they are deep diving now on the more development targets, and they will make those announcements as they finalize those. Yeah.
We still have time for one more question. Is Jack?
Thanks. Jag from Nuveen. Just curious on the Scope 3 inventory process that you're undertaking. I mean, just thinking about, it's obviously a substantial portion, the majority of emissions. One, if you could please clarify, I may have missed this earlier, but, will you also be next year announcing Scope 3 reduction targets? And I guess when should we think about kind of timeline of those being refined and I guess, in a very specific way? And then, thinking about kind of the Scope 3 reduction process, your Scope 3 is someone else's Scope 1 and 2. So I guess how much of this process would be, through partnership, negotiation, or, I don't know, outright coercion and or threat of eviction?
My ideal world, because of the logic that my Scope 3 is somebody else's Scope 1 and Scope 2. So in an ideal world, if everybody was good with their Scope 1, Scope 2, nobody has a Scope 3 challenge, right? but great questions. Okay, the first one, so there are 15 categories as per the GHG protocol. 5 we have already been measuring. The remaining 10, we have been working with an external consultant, a topic-specific consultant who's done this in real estate for a long time. And together with the help of that consultant, we have mapped out the whole portfolio, asset classes, countries. We have, especially for things like supply chain, we have scoped through our entire procurement data. That's why Paul's team has been very busy with our team to be able to track that out and convert that into the emission factors and the corresponding emissions. So the process is absolutely in accordance to GHG protocol and our operation control methodology that we follow. And if that means that there may be some readjustment of what was earlier in a different category of one of the 15 that needs to change, all of that will happen. So that's the process we are undertaking, and we are fairly confident that we'll have a good set of first numbers for all those remaining categories. Now, the thing to note on the supply chain numbers is that, of course, as a first cut, the methodology is spend-based, because as a starting point, that's the way you can start measuring them. As we mature and go forward, we want to move from spend-based to actual item-based or supplier-based, because that will help us to get the reduction. The thing with spend-based is it's good for baselining and reporting, but spend-based will not help us to reduce, because we don't know where to reduce or which suppliers to focus on. But the item-based and the supplier-based will get us to that next stage. So that will be an evolution we will go through. Second part of that question in terms of targets, I think we will wait to see how our inventory looks like, how the numbers pan out. And then we will assess what should be the right targets. Of course, at some point we will have to come out with the targets, because it has to get factored into our net zero as per SBTi. But we want to make sure that we've got the baselining right before we move to the target level. So I probably can't give you a timeline right now, but we are working on it already. That's a key focus for us.
Sorry, just to clarify on that. So you will incorporate Scope 3 in terms of your net zero targets as well?
As per SBTi, any new application now, you need to include Scope 3 in your net zero. We got SBTi validated a long time back. At that time, it was not mandatory. So the next time we go for SBTi revalidation, a part of our Scope 3 will get included, not the entire thing. So all those conversations we are having with SBTi, but eventually at some point in time, the entire Scope 3 will need to get included. But what is that right time, I think will depend on how confident we are about the robustness of our data. And this is where it gets back to data. Otherwise, it will be garbage in, garbage out. We want to make sure that the data robustness is good and scientific before we move to the next step of getting the targets done. And your second question of how to achieve, we don't think coercion or eviction of tenants is the right way, or coercion of supply chain, because in countries like India, I may not have any supply chain to work with if they don't meet all the criteria. I think it's a journey. I would split it into tenants and suppliers, right? With suppliers, it's a journey about categorizing them, and we have already been doing it, about which level they are in, tiering them. And then with each tier, working through both a carrot and stick policy to see how to move forward. In some places, even getting together with our competition to influence the supply chain may work, because we get significant economies of scale. And if the same supplier is supplying to 3 of us, it could work, right? So there are multiple ways to do it. And then, of course, there's continuous learning and development. Our procurement guidelines already have a minimum criteria that you have to meet. Otherwise, you can't even qualify. So there are all these things. We have a supply chain code of conduct that they already have to sign. So we've got a lot of things in place, but it has just to be taken to the next level. But I must admit that it will be a journey. It will not be a tap that just suddenly, otherwise, we suddenly drop off all our suppliers who don't meet the targets, and the business operations will suffer. So based on geography and the maturity in that geography, we'll have to take that call. And with tenants, again, it's a tiering. The multinational tenants who have their own net zero ones are the easier ones. So the names that you saw who are partnering with us, they are the advanced one already. And I think I'm less worried about those tenants. Our focus will be more on the SMEs and the smaller tenants who don't have the bandwidth, but they are equal part of our portfolio, and how to get them on that journey. So green lease is one strong example. We start the green lease journey with them. It may not always be from the beginning a darkest green that can be legally enforceable. It may be a lighter green, which is on a best effort basis, but it gets them on the table to have a conversation. It gets them educated about, okay, what is a green lease? What does it mean for the rating of my LED bulbs here, so on and so forth. So I think it's a journey where we'll have to handhold the entire ecosystem together with us and go from there. Otherwise, a brute force approach will not be operationally and financially feasible, and then we recalibrate as we go along. Yeah.
Thank you. And I think that's all for session 1. Can we give a round of applause for Paul and Vinamra? Thank you.
And I just hope that we have covered most of the other questions in the presentation. That's why we didn't go into them. But if there's any, we'll try to get them in the panel.
Well, we'll have a short break. You can ponder over the discussion. And if you have more questions, I'm sure we can also answer during session 2. So let's take a short break outside. We'll see you at around 10:35, about 15 minutes break. And please check out the booth outside. Of our online viewers, please be patient with us. Hope you join us back at 10:35.